So in this session, it's a pleasure to introduce our next speaker, Dr. Reed, who's a senior quantitative researcher and portfolio manager at Zebra Capital Management. He also has a connection to Rice, earning a BS in electrical engineering in 1987. He went on to earn a Ph.D. in the same field at Princeton in 1991. For 26 years, was a managing director at Morgan Stanley until 2010, then became president at MJ Reed Investment Consulting, and from 2014 to present has been a senior quantitative researcher and portfolio manager at Zebra Capital Management. And today, Dr. Reed is going to give a talk on popularity characteristics in ESG investing. So thank you for your time.
Thank you. From looking at the previous talk and what Dexter was talking about earlier, I'd say as students, one really important thing when you get into the workplace environment is capture as much data as you can. And Dexter was mentioning the tick database that they had developed for keeping track of every terabytes a day. We had a guy in PDT who just took the initiative. I guess he had worked at Bloomberg and Salomon Brothers beforehand. He just said, I'm going to capture every tick on every stock in the world. At the time, it wasn't as much data as it is now, but we tried to hand it off to Morgan Stanley, and they said, well, we need $40 million and a full-time staff of 5 people to do what this guy was doing, with 10% of his time. But that became just an invaluable resource for doing the types of microstructure research that she was talking about in the last presentation. This work that I'm going to show today is sort of the second best type of research. The best type of research is things that I've done with statistical arbitrage or microstructure strategies, where you have a bunch of price data and news and factor models, and from that you predict future returns and hopefully these returns that you can participate in. The problem with research like that is that, one, if it's any good, you're not going to share it with anybody because it's probably going to be a profitable trading strategy. And secondly, predicting return streams doesn't give you any idea of what's sort of motivating the market participants. So we would have these statistical arbitrage models, and then we would spend all this time speculating as to what was going on that caused the returns to behave this way. Where market makers averse to taking overnight risk? Is there an information delay in the market? Whereas this problem, basically a few years ago, we started seeing at every conference. There was ESG sessions. There's articles on Bloomberg every day about ESG. And with all this interest in it, it just became apparent that there'd probably be some opportunities for identifying some mispricings and some market inefficiencies that we might be able to do something with. So ESG, as I mentioned, has been just exploding in popularity. Environmental, social, and governance characteristics of the companies, and also just ratings for funds in general. Just some data from the last few years. Morningstar puts out a ESG Fund Landscape report every year. Last year, 36% more funds, 534 funds, call themselves ESG. A lot of them are just rebranding existing funds. They take an existing fund, doesn't have a lot of AUM, rebrand it as ESG, and hopefully drive some interest into raising additional funds. Some of the biggest asset managers, BlackRock, TIAA, are overlaying ESG as part of their investment process. So every one of their fund products, whether mutual funds or funds that they run for pension funds, advisory clients, all have an ESG overlay. And as I mentioned, Morningstar, in addition to this landscape report, they have a sustainability rating that they give every fund that you can look up on their website. MSCI also makes publicly available their ratings for funds, because a lot of the demand for ESG comes from retail investors who want to be able to look at, their options in their 401k or IRA and see, which funds have an ESG component. So, what ESG means varies. There's no set definition. The Europeans have attempted to put a little bit of a regulatory structure on it. It's a great paper available on SSRN by Berg, Coble, and Rigobon, which goes over the ESG scoring. There's 7 ratings agencies that basically do a very deep dive into companies and score them based upon their environmental, social, and governance characteristics, and a lot of sub-characteristics. And there's obviously a lot of correlation between these scores, but there's also a lot of difference in the way that they rate. This paper does a lot of statistical analysis on those scoring systems. Yeah. So there are also, in addition to different scores, there's also different methods of ESG. The oldest is what we call socially responsible investing, which was basically a negative screen. Remove sin stocks, gambling, alcohol, tobacco, defense contractors. Governance has been part of the investment process for a while. A lot of the big asset managers have sort of criteria for minimal governance standards in terms of the board independence. Lately it's been more about sustainability, in particular carbon emissions. Big Twitter argument going on right now as to whether a long-short hedge fund is really zero net carbon by offsetting the long positions with shorts. And then, over the last couple of years, diversity, not just diversity of the board and management, but diversity of the employee, what employee policies has also become an important, criteria. And, for each of these, there's specialized, each of these last 3, there's specialized funds that are not just ESG, but, there's a women's, fund that invests in stocks that empower women. There's a fund that, specializes in just carbon emissions. So you can find subsets of ESG funds as well. And then, there's some funds that are, will basically, buy only the highest rated ESG using the sort of manager discretion, versus some that just sort of screen out the lowest ESG scoring names. And, for active, there's been 3 big managers with long track records: Parnassus, Pax, and Calvert, that run very big, very concentrated ESG funds or socially responsible funds. Versus passive, for example, BlackRock has 4 separate multi-billion-dollar index funds, each off a different ESG index. So you get to choose which particular ESG flavor you want from them. So as it comes out, this ESG portfolio that everybody's interested in, everybody wants, but coming from 7 different ratings agencies, all with different criteria as to being weighted different ways, and different portfolio constructions. So it's not a well-defined thing. So to me, as a quant, I look at this, see lots of investor interest, lack of standardization, and I see an opportunity to identify mispricing and potentially do something with it. So when we started working on this, there's these 6 or 7 different ratings agencies. Each of these costs, tens of thousands of dollars a year. It's unclear whether, except for a few of the indexes that are very well defined in terms of how they map the scores onto a index, it's unclear how the portfolio managers actually even use these scores. So we decided to look at what the portfolio managers were actually doing. And to do that, we created a crowdsourced ESG portfolio. And the way I did this was I looked at the Morningstar report from 2018, picked out the 19 largest ETFs and mutual funds that they had there, used their publicly updated holdings reports from the SEC website. And as a result, I'm just basically combining together what the portfolio managers are doing in aggregate. I'm not attempting to choose any particular scoring system. I'm just relating how they're actually acting upon both the ESG scoring that they're using and also just the realities of constructing a multi-billion-dollar portfolio in the marketplace. Now our goal was to identify the stocks that are going to be added into this crowdsourced portfolio. And we want to identify the ones that these portfolio managers are going to be selling in aggregate. So, it turns out the best predictor we found for what's going to be added into the crowdsourced portfolio is the things that were added over the last 3 months, the stocks that were added over the last 3 months. And, we do have to adjust because if a fund doubles its AUM, if it kept all its positions the same, it would double its holdings in every stock. And similarly, if a stock in a portfolio doubles in price, its weight is going to double without the portfolio manager actually buying any additional shares. So the question is, why is this momentum in the portfolio additions that we've identified? Well, one is, there's this, a company changes its policies, it takes a while for the various ratings agencies to update their scores to reflect that, perhaps the company's board has more diversity than it did before. There's also, a well-known effect from analyst ratings in general and portfolio managers. There's consensus forming and hurting. People like the confirmation bias of finding out that other people are doing what they're doing. So when one ESG manager adds a stock, it sort of gives permission for other ESG managers to make the same decision. And then there's just like an implementation lag. If you're running a multi-billion-dollar portfolio, you can't, in a small cap stock suddenly, is recognized as ESG. You can't simply go out and buy huge amounts of it, over in a short period of time without impacting the price. So one thing I should note, we're not just, the excess returns we're identifying for these things that are being added are not based upon continual flows into ESG funds. We're sort of looking at the incremental flows due to stocks being bought by the portfolio managers in addition to what's coming in from the fund flows itself. So, it's some people have asked me, is this just relying on the fact that, there's ESG's popular, money's flowing into it? It's like, no, because we're sort of trying to identify rotations into and out of ESG portfolios. So it turns out, my first instinct was I'd find this momentum in the stocks that are leaving the ESG portfolio as well. And the things that had been reduced in holdings over the last 3 months would continue to be reduced. But that's actually not the case. What it turns out predicts things leaving the ESG portfolio are the stocks that are most widely held among the funds. So there's the most consensus among the portfolio managers. And the things that they are holding overweight relative to the market index. And this it took us a while to think about this, but basically what's happening here, if there's a consensus among the ESG managers that something is fully ESG compliant, they're not going to add any more, right? Particularly if they're already overweight relative to the index. And if it's widely held, overweight, and has a high ESG score, there's a lot more room, even if this is like a random process, a lot more room for this to move negatively, revert to the mean. And I think the third, which may be the most important effect, is the stocks that they're most overweight are going to be the biggest risk for them for tracking the index. So if an ESG manager has a 5% position in Apple and it's a 3% index weight, that 2% difference is a lot more tracking error than just being off a few basis points and a bunch of smaller names. So these were the results. The green lines are the stocks that we've identified as being added to the ESG portfolio. We're calling it ESG trending. The red are these ESG popular, the ones that there's a consensus among the fund managers. And the blue is just the things, the average of all the stocks in the ESG crowdsourced portfolio. And what we're looking at is forward monthly holdings or change in holdings. So on the y-axis, that's the percentage change in the position in the crowdsourced portfolio. Now we don't get the fund reports until the end of the second month. So those changes the first 2 months aren't actually realizable. But what you can see is that the popular names over the course of 12 months, the average position size or median position size goes down about 15%. And the names that we've identified as being added to the crowdsourced portfolio increase 10 to 15% over the same time period. And every stock in the portfolio, sort of the baseline, increases slightly over that period. So we've been able to predict what's being added to the portfolio and what's exiting the portfolio. The next step is to see, do they generate any excess returns? So like I said, we created this ESG trending portfolio. You buy the stocks that are being added to the ESG portfolio, with a 2-month delay because you don't know for 2 months until the fund holding reports come out, and you hold them for 6 months. Similarly, this ESG popular portfolio, you short the stocks that are overbought, overweight, and hold it for 6 months. And we update these portfolios monthly and rebalance them as new reports come out. So this is the long side here. The green line is the cumulative return of the ESG trending portfolio over the last 4.5 years. The orange line is the Russell 3 index, and the blue line is the crowdsourced composite ESG portfolio, which is actually, you could implement simply by buying the 19 funds and ETFs weighted relative to their AUM. The two interesting things that come out here. One is that over the whole period, the ESG trending portfolio does outperform by about 9%. It did underperform for a period from mid-2019 through mid-2020, and it's very volatile. The second interesting observation is this composite ESG portfolio basically gives you the same return as the Russell 3. And this, I don't have fees in here, so by the time you pay those funds fees, it is, you don't really see it here, it is slightly lower risk, but it's basically, but in some sense, when I showed this to the guys I work with, they said, that's actually a good result for them because it shows that they don't lose anything to track the index, and they give their customers the satisfaction of buying an ESG portfolio. The short side is a little bit more interesting. So the red is the ESG popular portfolio, the stuff that's most widely held, most overbought. The brown is the stocks that are in the Russell 3K that are so unpopular, they're not held by any of the ESG funds. Those are the ones that, like, as a bank, if you refuse to do business with them, the state of Texas won't let you do municipal underwritings. I don't know if you're familiar, Texas has now passed these laws where if like banks refuse to do underwritings with certain companies, they're not allowed to do municipal work in the state of Texas. You know, like particularly like certain, there's like BlackRock and a few other people are refusing to invest in certain sectors and weapons and gun manufacturers, things like that. Anyway, so the red consistently underperforms the whole period. So it's a good short portfolio in that sense. The brown actually, interestingly, has a big upstreak from late 2020 through sort of the middle of last year, and then is the non-ESG stocks. So it has underperformed, but with a lot more volatility than our short portfolio. So, in conclusion, all this emphasis on ESG, any sort of lack of sort of standardization, it creates a diversity of opinion, dispersion, and mispricing opportunities that we've identified as, potential investment strategy. The advantage of using this crowdsourced portfolio is we're essentially removing any of the biases and noise associated with these ratings, these scores. We're actually, working directly off the portfolio manager's actions, not their input data. These fund flows for the stocks that are being added or removed from the portfolio tend to last for at least 12 months. And we see excess returns in the funds that the stocks that the ESG managers are buying, lower than market returns for the stocks that they're selling. And I've done some additional work where there's been a question: is there actually an ESG factor? I didn't really have time to present it today, but I constructed an ESG factor from 2 different sources, and it was surprisingly consistent. So I'd be happy to share that with anyone afterwards if they want to take a look. It's a little bit more quantitative than what I've shown so far, but it was kind of an interesting result because there's been some question as to whether or not there is really even a ESG factor. That's it. Questions?
Okay, so I'll start off with the first question. So the aggregation is a crowdsourcing aggregation. Have you compared this with other well-known aggregators, like let's say Probit aggregators or median aggregators? There's a large literature on aggregating forecasters, and in some sense, right, you have crowd aggregation. People are forecasters. Not all of them are equally knowledgeable. Not all the indices are the same. Have you compared any other aggregation scheme to the crowd aggregation?
No. And the crowdsourcing term is probably more accurate from like a buzzword than it is, because it's not really like a crowd as much as we're just combining a bunch of portfolio managers together. It's not like a Reddit forum where we let the crowd determine the ESG characteristics of a stock. But that is an interesting approach to take. I mean, I think part of what we were working with a pretty limited budget here, and we wanted to see what could just do with publicly available data. I mean, I think the next step would be for ETFs, it's pretty easy to get daily fund holdings rather than waiting for the SEC reports, which take 2 months. So that would be the first incremental improvement we would make, because about half of our data is coming from ETFs, and we could get more frequent updates with them in terms of finding out what the actions are going on in aggregate among the portfolio managers.
Thank you. Yeah.
Could you go back to slide 11? There we go. Nope, one back. Okay, thanks. So the turning point of that green line from underperforming to outperforming was COVID. And we see the big drop, the COVID-related drop in stocks. So this obviously means that, you know, the stocks that performed dramatically well during that period are also ESG friendly, Home Depot or, you know, supply chain related companies. Do you think we're looking at anything more than COVID's effect on all this?
Yeah, there's actually a lot going on. We've looked at a bunch of, you know, sort of factor decompositions of this portfolio, right? You know, so this is an equal weight portfolio. The other two you're comparing it to are much more cap weighted, right? So that's one, there's a big size factor exposure difference. There's also some sector biases, right? The ESG fund managers tend to like technology, dislike energy. So that creates some difference. I will say that the in-sample period for this work ended, was basically fall of 2020. That's when we sort of came up with, these are the criteria to be the predictors. So a lot of the outperformance came in the period where it was out of sample in terms of model development, but before we went live with it. So it's sort of, you know, bad timing that we happened to go live at the period where the, you know, the green line was peaking. But it's the same thing on the short side. I'm comparing an equal weight short portfolio to index, which is market cap. But the non-ESG portfolio, the brown one I was showing, was equal weight as well. So you can make them, you know, cap weighted to get rid of some of the biases, but then you're not really showing what you'd actually be constructing.
How many names does it generate along the short side?
Can you repeat the question for the video?
The question was, the question was how many names are in the portfolio? The short portfolio is about 100, and the long portfolio varies from 200 to 300. We monthly, so when I get back to work later this week, the SEC reports will start coming in and just process them, and we look at what's been added over the next 3 months, and those names will be added to the portfolio. And similarly with the shorts, there's a lot more correlation from period to period. No, I tried optimizing, and it didn't generate much improvement. You know, it was able to get rid of these, like what I was just talking with Dexter, like some of the size effect and the industry exposures, but it also seemed to hurt the performance. And I think that's because, you know, we're basing these things on what the portfolio managers, they do seem to have some alpha. Besides, you know, just choosing the name of the stock, choosing the names of the stocks. So when you optimize it, you're taking away some of the alpha that they're providing.
Some questions in the chat.
And there's Q&A.
So the first one will take.
So Dr. Key writes, have you considered this strategy in other smart beta products such as factor funds?
Yeah, we've actually talked about that, and I think the problem is I don't think there's enough. It would work if there's enough fund managers, right, that you could create this crowdsourced portfolio, but it might work for, like, say, like technology funds. If you aggregated together a bunch of technology ETFs and funds and tried to discern what the portfolio managers were doing in aggregate from those. The problems, I think, with like the smart beta funds, I'm not sure if there's enough funds in the space to create the crowdsourced portfolio.
The two in the chat are previous, yeah.
So in your crowdsourcing or your ESG portfolio, did you find certain ESG fund managers that were outperforming? Or was that a question that you asked?
That was an area of research, and it wasn't so much are they outperforming, so I don't know if there's enough data, but it was more like, are there trendsetters versus laggards, right? Are there fund managers that sort of predict a name being added before others? And I didn't find that. What I did find was funds that had less than 100 holdings. I ended up excluding them because, particularly, like I mentioned, there's like Calvert and Parnassus, they're managing several $billion in less than 100 names. And when they buy or sell something, it's overweighted just because of the size of the fund and the fact that it's so concentrated, that it was just adding more noise than it did signal to our prediction algorithm. So I just started excluding all funds that were less than 100 holdings, which I think was only about like 4 or 5 of the 19 funds.
Are there, hello, okay. Are there other questions from either the audience or the chat? Okay, so this is a good time to break. Let's thank again Dr. Reed for the talk.